Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, and restack buttons. Well, is the stock market on the verge of a big crash? Well, I believe the answer is yes. That's what the data is telling us. That's what historical trends tell us. And we're going to talk about one particularly relevant data point that triggered at the market close yesterday, and history tells us that means a market crash is coming in the very near future. So we're going to talk about what that is, why it's relevant, and of course, most of all, why is any of this relevant to Bible prophecy? Because it absolutely is. So, what is the particularly relevant data point that triggered at the market close yesterday? We've talked about this for a long time. I'm not sure if it's a year and a half or 2 years. I'd have to dig through all the videos to find out what it was. But it's this right here. I've been telling people in videos for anywhere from a year and a half to 2 years. I can't remember exactly what day was the first day I said, look at this, but I've been pointing this out, saying, watch this 2-year, 10-year spread in U.S. debt. It's called the yield curve. And historically, this is the most reliable indicator of economic downturn, of recession. It's been almost 100 years since the Great Depression, so this data goes back really reliably 50 to 70 years, showing us, and we have to look at the last 50 years because that's the modern monetary system since Nixon closed the gold window that tells us the environment we're operating in. But this has been 100% reliable over the past 50 years, indicating when recession will occur. And so I've been saying this number has been negative since July of 2022. That means the yield curve was inverted. And when you have an inverted yield curve, they precede or sometimes overlap partially recessions. And so I said, what indicates that it's coming, because the media gets it backward. They say every single time this happens, and I've witnessed this several times in my life, they'll go, well, the yield curve has inverted. So that means we should have a recession. And they start freaking out about the inverted yield curve. And then the recession doesn't come and they say, oh, okay, it's different this time, right? It's not the same, but it's not the inversion of the yield curve. It's when it goes back to normal. Because normally you would expect that you would want a higher return on lending cash to the government for 10 years than you would lending it to them for 2 years. And so that spread between the interest rates, if you get a higher interest rate for lending for 10 years than you do for lending for 2 years, then you have a positive number on the yield curve. It becomes inverted, meaning it's a negative number when there's a higher yield on the 2-year than on the 10-year. And we'll talk about why this is a key glimpse into what's happening in the economy as we go through this. But yesterday was the first time this number has closed positive. It briefly went positive, I believe, on Thursday, or at least at 0. And it briefly went positive on August 5th when we saw the Nikkei have the largest 2-day crash in history, the Japanese stock market history. But that was intraday. It did not close at a positive number. So it did not uninvert at that time. Now, we've stated in the past, to confirm this, we would want to see this stay at a positive number for several days or weeks. I think there's a strong possibility that's what we're going to see. The Federal Reserve meets in about a week and a half on September 18th. They will meet to discuss whether or not they're going to cut rates. It's expected they will. I believe that is what this is anticipating. And so I believe that will stay that way. If we get a surprise and they don't, we could see this change. But I think if they do, then so September 18th, we should have a pretty good idea if this is confirming what we're seeing. So again, when we look at this data here, let's go back 5 years. It's been since July of 2022 that this has been a negative number. Now, let's look over at the Federal Reserve Bank of St. Louis at the 10-year, 2-year yield curve, and we can see these little shaded areas. Now, for some reason, they used to show this data going back much farther than 1976. But for whatever reason, they decide from time to time, oh, we're just going to eliminate this data. We're going to hide it over here. And they don't want us to see it. But this goes back to 1976. And all of these shaded areas we see are confirmed recessions that took place. And we can see how the yield curve inverted prior to the recession, then uninverted, inverted, uninverted, inverted, uninverted, inverted, uninverted, on and on. Well, here we are in the present day. We had the slight inversion right before the COVID crash. But here we've had the longest period of an inverted yield curve, and now we have an uninverted. That tells us that this is coming, and there's all sorts of data points. Sometimes the recession comes 8-9 months after this. Sometimes it's an indication that the recession already began, and I think that's the case. That's what we're going to see here. That's what we saw back in 1980, 1981. Very similar circumstances where we've had an inflationary environment similar to what we saw in the 1970s. I think we're going to see something similar here. Now, and it's not always that an inverted yield curve becoming uninverted leads to a market crash, but I believe in this instance it is, because there's different types of ways. There's 4 different ways that we could see this yield curve uninvert. And if we go over here to Real Investment Advice in this article by Michael Leibowitz, he actually wrote this on Wednesday, I guess, anticipating, because we've been watching this, that we would see this uninversion. And he points out there's a particular type that we're seeing now called a bull steepening cycle. And it says bull steepening cycles are bearish for most stocks. Having defined the periods, he says, we then studied various stock indices, sectors, and factors to assess their performance during the time frames. To remind you, bull steepening trades typically occur when the economy is slowing. And guys, that's definitely what we're seeing. God willing, I'm going to do a follow-up video to this for Monday that talks about that aspect of what we're witnessing from this. It says, in anticipation of Fed rate cuts grows. That's exactly what we're seeing. It's widely anticipated that on September 18th, the Fed will cut rates. It says those traits adequately describe the current period. Furthermore, and of importance, the current steepening is occurring from a yield curve that has been inverted for 2 years. Inverted means the yield on the 10-year is less than the 2-year. An inversion reduces the incentives for banks to lend, thus further increasing the odds of economic weakness. So think about it. If you're a bank and you can say, I can get a better rate if I simply buy a 2-year U.S. government bond than if I make a auto loan or a mortgage loan for a longer period. Well, why wouldn't you just do that? And that raises those lending standards, makes it harder for individuals and companies to borrow cash. And as we've talked about in our current economic environment and our monetary system, it's reliant on ever-increasing amounts of debt in order to avoid a crash. And so when those debt levels reach their peak, that's when we see the downturn. It says, as noted in part 1, the yield curve inversion is a recession warning, but is not usually timely. Contrarily, the yield curve uninversion typically portends a recession coming within a year or less. And again, I think we've been in that recession depression since October of last year. It's a year or 2 years down the road before they recognize when it begins. That's just historically what happens. It never in real time do they say a recession started last week, right? And then, 2 years later, all these things start happening. It says the yield curve briefly returned to positive territory as we put the final edits on this article. So again, this was written on Wednesday. Yesterday closed well positive. It says we therefore have a much more explicit recession warning. And he says the graph below shows that even though we have a firmer warning, a recession can take more than a year to enter. And this data only goes back to 1985. So under this, he's saying anywhere from 84 to 287 days, which would be somewhere between November of this year and June of next year, would trigger the recession. But again, if we go back and we look at the full data, we looked at 1980 and 1981, those recessions were already in place. So it would be negative number of days rather than 84 days or 287 days away. But either way, we're looking at a situation where historically either the recession has already begun or no later than June 20th, if it takes 287 days, we will see that recession begin. And guys, we'll look at more data on Monday, as I said, God willing, that's going to show we're not 287 days away. We're in the midst of all of this right now. And we looked at some of that data recently, I believe, in yesterday's video on the global depression, what's happening in China, what's happening in Germany, really what's happening all around the world. So let's take a look at this tweet as well from Britt, ETH. He says, in 13 days, and I think he had written this, on September 5th. So this is from Thursday. He said the Fed will likely make its first cut of this cycle. So they'll begin cutting rates. And again, if you listen to the media, they think, oh, when the Fed begins to cut rates, it's going to be wonderful. It's going to lead to this economic surge and stocks are going to go up. But historical data says the exact opposite. It does not. That's not what history tells us. So I don't know why they push these ideas out, but it's not necessarily for political reasons because they've done the same thing in the past. But he says, I've overlaid the past rate cut years on top of the current NASDAQ chart. 1990, 2001, 2007, 2020. As shown on the bottom two charts, these four cutting cycles matched the economic data that we're seeing currently. That is, the unemployment rate is curving up, the U.S. economic indicator is curving down, the yield curve is no longer inverted, etc. He says the softest sell-off out of these four was 1990 with a decline of 24% after the cuts. So again, the media would tell us, Fed cuts rates, that's great for the market, it's going to juice the market. That's not what history tells us. It tells us at least we're going to see a 24% decline in the market. Now again, we'll look at some data as we go on in this video, that doesn't mean 24% in a day or in a week, but from peak to bottom. That may take anywhere from 3 years. It could happen in a couple of days, as we saw with Japan a month ago. But it's most likely you're going to see a sharp sell-off that captures the media headlines, but you're going to see the slow downward trend over the course of a couple of years. That's what we saw in the Great Depression. It took about 3 years from the peak in 1929 to the trough in 1932. So it says, as shown in 2000, the NASDAQ went up 22% after the cut, before it fell more than 50%. So you may see an initial surge in stocks, I don't know, but the long-term trend over the course of weeks and months and then years is down, not up. He says it's worth noting it was already down 54% before the first cut. To put it in perspective, that was the dot-com bubble. The NASDAQ from peak to trough over the course of 3 years was down 80%. So for every dollar you had in that market at the height, at the peak, you had 20 cents at the bottom 3 years later. He says, will this time be different? And of course, the answer is no, it's not going to be different. That's not what history tells us anyway. Maybe I'm wrong, but I'm going to go with what all the data and history is telling us. So let's take a look at this article from justdario.com, who's been on top of this. We've looked at several of his writings in the past month. He says the U.S. yield curve is screaming danger. And once again, nobody is listening, meaning, again, the media loves the idea of rate cuts. We're going to cut rates. They've even said, I've heard people say, well, they're going to cut rates because that's good for the Biden-Harris administration. But it's actually bad for the Biden-Harris administration because it could very well trigger a crash before the election. So they don't know what they're doing. They claim they know what they're doing, but they don't necessarily know what they're doing because they aren't studying this data, or they have another agenda, a narrative that they're pushing. But this is what history tells us. He says the U.S. Treasury yield curve is one of the most important indicators in global financial markets, serving as a reflection of investors' sentiment, economic outlook, and central bank policy. By plotting the yields of government bonds across different maturities, so 10-year maturity date, a 2-year maturity date, the yield curve provides insight into the direction of interest rates, inflation expectations, and economic growth prospects. It's not only a key gauge for policymakers and investors, but also directly impacts the pricing of a wide range of assets, including corporate bonds, equities, and real estate. Movements in the yield curve can send powerful signals about the future state of the economy and have significant implications for the cost of debt, risk premiums, and asset valuations. Assets like the stock market, assets like real estate. So he goes on, and we mentioned there's 4 types of these yield curve uninversions. There they are. I'll link to this article in the comments if you want to go read it in its whole, but it's very technical, so I don't want to bore people. So we'll just cut to the conclusion right here, right? The conclusion being, why is the U.S. Treasury yield curve currently screaming danger? He says, what I just described not only enabled a use of leverage never seen before, leverage meaning people took out loans when we talk about buying stocks on margin, things like that. It's borrowing money to speculate in the stock market and the real estate market. And it blows these big bubbles that pop, just as we saw in 1929 just as we saw in the dot-com crash, just as we saw in the great financial crisis with residential real estate. He says, what I just saw described not only enabled a use of leverage never seen before, but because the curve was inverted, the lower long-term rates effectively boosted companies' valuations, ultimately inflating one of the biggest stock market bubbles in history. And that's not an understatement. We'll look at that in just a moment. He says, as a matter of fact, central banks, led by the Fed, created an incredibly fertile ground for a stock market bubble to grow to the sky. As of late, they even worked tirelessly to make sure the very same did not pop under their watch. As he previously highlighted in this article, he says it was very clear what their real goal was lately. Make sure the U.S. yield curve did not invert. Unfortunately, even if they tried to kick the can down the road as long as they could, ultimately market forces prevailed because, quote, it's never different this time. So again, I'm not a prophet. I don't know what the future holds. I don't know what the market's going to do, what the economy is going to do. But I know what history tells us. And history tells us when we see these things we're seeing now, they're usually followed by these other things, right? So it's common sense to say, hey, we're seeing these things we've seen over and over again in the past. We should probably expect a very similar outcome to what we've seen in the past. That's why he means it's never different this time. And as of today, the very important spread between the 2-year U.S. Treasury yield and the 10-year U.S. Treasury yield is back to positive. And again, we've been pointing to the sign for a long time, saying when this happens, the siren light should be going off. That's your warning. We're on the precipice of all the things we've been talking about. He says, we just saw above that when a bull flattening of the yield curve occurs, and this is one of those types of yield curves, he says it tends to anticipate an imminent Fed rate cut. And again, that's what people expect in a week and a half. But at the same time, it also anticipates a weakening of the underlying economy. And that's the big thing that the media is missing when they say, we need to cut rates, because they think that's going to just magically lead to the strong economy. Typically, when the Fed starts cutting rates, it's in reaction to the economy in free fall. That's why it never turns out the way they anticipate. They always talk about it's a soft landing. The Fed's going to engineer a soft landing. You can go back and you can read the same stories. It's like the media puts these stories on a shelf. Let's bring it out and talk about why the economy is going to do just fine. They're going to engineer this soft landing. They said the same thing during the Great Recession. They said the same thing during the dot-com. We've seen this story before. We've seen this movie before. He says, today's situation, though, is very special because central banks let the inflation genie out of the bottle. And despite the constant efforts by governments, central bankers, and the mainstream media to make everyone believe inflation has been put under control, the reality is very different, and the genie is still very much free. As a consequence, a Fed rate cut combined with a very unique and fragile equilibrium and financial markets will be particularly damaging this time when this event by itself has already consistently been a harbinger of an incoming stock market crash, as you can see from the chart below. So here, this red line is the S&P 500. This is the yield curve, the black line. We see the uninversion, we see the crash. We see the uninversion, we see the crash. We see the uninversion, we see the crash. See the uninversion, we see the crash. We just had another uninversion. So that's going back 30 years, over 30 years, 35 years. He says, to conclude, the U.S. yield curve is screaming danger as loud as it can, as it always did. But yet again, nobody is listening. And he's saying that in the sense of the wider media, the average person has no idea. Financial media is ignoring this. You and I aren't ignoring this. We see this. But he says even more concerning is the fact that in the age of endless money printing or currency printing and perpetual bailouts, people are now so convinced that central banks have gained such a degree of power to shape financial markets that they can rescue every stock trader in case of a downturn. So we'll confirm that that's exactly what they think in a moment. But that's called moral hazard. They're creating these conditions where people think, well, the Fed will come to the rescue. They'll save the market. So if there's a downturn, I'll just buy in on the downturn. I'll buy the dip. And then I'll ride it right back up as the Fed comes in to save the day. But what happens when the Fed comes in to save the day and it doesn't work? There's going to be a lot of people in panic mode. It says all these people, however, are ignoring that this time the very same central banks are in need of a bailout themselves. Considering we are just resurfacing from the longest U.S. yield curve inversion in history, the amount of debt has grown to biblical levels, and stock valuations have been inflated through the stratosphere because of the combined effect of abundant access to leverage and abuse of derivatives. Is this what we saw in the Roaring '20s that led right up to the market crash at that time? He says it's objectively very hard for me to embrace the, quote, soft landing narrative mantra everyone keeps chanting. It's undeniable that the incoming market crash is going to be of historic proportions, and it will be very hard for governments to save their skins one more time through the wild monetization of deficit spending. In other words, let's spend, let's bail out, let's hand out stimulus checks, let's do everything we can so that we get reelected. It's not going to work this time. They built up too much debt in the system, and because he mentioned that inflation genie has been let out of the bottle, if they try to issue all these stimulus checks, eventually you're going to get massive, massive inflation, out of control inflation. But we're a ways away from that. That's not going to happen immediately. I think that's 3 or 4 years down the road. Hopefully we're not here and we're long gone by then. But let's look at this tweet, which we visited back at the time that it happened on August 5th when we saw that huge market crash in Japan. It was spreading overseas. And we saw the Federal Reserve's Austin Goolsbee said, if the economy deteriorates, the Fed will fix it. So there you go, this belief that, well, the Fed can fix anything. There's no need to worry about any of this. Just buy the dip when the market declines because the Fed's going to come to the rescue. Everything's going to be fine. And Lawrence Lepard replied, I'll take hubris for $1,000, Alex. So we pointed this out at the time, and we also pointed out what the Bible says in Proverbs 16:18. Pride goes before destruction, and haughtiness before the fall. Guys, it's not different this time. History tells us, again, I'm not a prophet. I don't know exactly what the market's going to do, but I know what the data says, and I know what the history says, and we went over much of it right there. But let's look at just how overvalued the stock market is. So this is called the Buffett Indicator. So Warren Buffett developed this to determine when a market was overvalued versus undervalued. And it measures the value of the stock market relative to the entire economy. Meaning the stock market should not be valued more than the entire economy because, well, that just doesn't make sense, does it? How can a select number of companies be worth more than, well, everything, right, in the economy? So generally, a ratio of 60 to 70% he considers fair value. Right now, depending on which indicators you look at, because people use different indices to develop this. Basically around 200% right now. So this one here is looking at, I don't know exactly what market they're looking at, but they have it at 202%. It says this ratio fluctuates over time since the value of the stock market can be very volatile. So this was as of June 30th. But GDP tends to grow much more predictably. The current ratio of 202% is approximately 63.27%, or about 2 standard deviations above the historical trend line, suggesting the stock market is strongly overvalued relative to GDP. And to put it in perspective, the current Buffett Indicator valuation, no matter who you look at, no matter which one, and again, you can go look these up in search engines and look at charts over time, but the market currently is more overvalued than the 1929 market, more overvalued than the dot-com bubble, and more overvalued than the market was prior to the great financial crisis and the sell-off that occurred there. So we have an enormously overvalued market. Right when these trends are telling us that the market is going to crash, we also have this right here. So this is the US dollar Japanese yen exchange rate. And I won't get into the details of the yen carry trade again, but you can go back and watch past videos where we discussed that. And that was the catalyst for the sell-off we saw 1 month ago, when the yen was pushing the levels we're seeing right now. So back on August 5th, intraday, the low was 141.66 yen to the dollar. We're now at 142.27. So we saw, in the aftermath of that miniature correction, we saw it climb all the way back up almost to 150. Well, now it's back down to those levels when we saw the massive sell-offs. So again, that indicates to us that there's pressure on this yen carry trade again. Now, the reason we say it isn't different this time and cutting rates isn't necessarily good, well, the yen carry trade, if you remember, is predicated on the difference between the interest rates on Japanese government bonds and the interest rates on other things all around the world, but in large part the United States. And so if the United States cuts rates, well, that actually narrows that spread. The Japanese yen carry trade is facilitated on a widening spread, so a narrowing of that spread, which is what we saw when the Bank of Japan hiked rates 0.15%. So that 0.15% move is what caused that crash. If the Fed comes in and says, well, we're going to cut 0.25 or 0.5, as they're saying, well, that is essentially the same as the Bank of Japan saying we're going to hike by that amount. It condenses that spread, narrows it, and kicks off, once again, that yen carry trade unraveling all across global markets. So all the people that are anticipating, oh, the Fed's going to cut rates, that's great, might be surprised at what the reaction is from the market when the rates get cut. And we're also seeing this right here. So this is called the VIX. This measures volatility in the market. And again, this is what we saw. We saw an intraday peak on August 5th during that market turmoil of 65. Right now we sit at 22, but both of those are elevated numbers we haven't seen since almost a year. So we're seeing this rise again right now, which is indicating those markets are looking ahead toward more volatility. So guys, when we talk about a crash, I mentioned this doesn't mean we see this massive meltdown in a single day. It takes time for these things to play out. So let's take a look back at this macro trends website where we can look at a chart of the 1929 Dow Jones crash. As we see here, we had this peak in September of 1929, and then we have this crash here that took place in October. But keep in mind, in the months that followed that, well, it sort of went back, regained about half of those losses. And in the spring of 1930, you can go back and read the articles. People were saying, oh, the worst is past. Everything's good now. Yeah, back here we wiped out all these people that had borrowed cash to buy stocks. They shouldn't have leveraged themselves like that, and they got wiped out. But now everything's back to normal. Confidence is restored. We're in good shape, and people were buying back into the market. And then it went down again. And then they said, oh, the worst is over. We'll buy back in. And then it went down again. Oh, the worst is over. Let's buy back in. Up, back down again. Oh, look here. Now we're really up. And then down. And up. And then down. And up. And then down. And then just down. So here we are, a little more than 2.5 years after the October 1929 crash. And we get down to the lows that took place. But it took till the market didn't reach this high again until 1954. So it took 25 years for the market to get back to break even from that market high in 1929. And from the peak in 1929 to the trough in 1932, the market lost, I believe it's 89% of its value. I don't know if we're going to see something that significant here. My best guess is probably not, but we could see 60, 70, 80% loss. And on the other side of all this, I think they're just going to print cash and hand it out to everybody because the politicians, the central bankers will be panicked over the prospect of losing power, and people tend to vote for those who promise to hand them cash. That's just the way it is. And so on the other side of all of what's coming, we're going to see, well, massive hyperinflation, in my opinion. But let's look at this chart. This is of the dot-com bubble and the NASDAQ. So this is a chart of the NASDAQ. Look at this huge peak here. It had a bit of a crash in 2000. Well, then it came back up. It recovered. Everybody's happy. Up. Then it went down. Then it went up. Then it went down. Then it went up. Then it went up. Then it went down. Up, down, up, down. And from peak to trough, you're looking at an 80% decline. Again, for every dollar you put into the market up here, you had 20 cents 3 years later. About this, let's take a look at this. This website says how the S&P performed during major market crashes. And has a nice infographic here that tells us that. So in the COVID crash, peak to trough was a 34% drop. Black Monday back in 1987 was a 29% drop. The global financial crisis 15 years ago, 57% drop. Dot-com bubble, 49% drop. Again, that's the S&P 500 during the dot-com bubble. The NASDAQ was worse. That was an 80% drop. Nixon shock, OPEC oil embargo, 48%. So all of these are during the lifetime of most of us. These are, and then we finally get to, they've got the Great Depression, an 86% drop. I believe the Dow was 89%. The S&P 500 didn't exist then, so I guess they get this figure from emulating what it would have been. I don't know where they get that figure from, but again, it's approximately right and a reflection of what the market did back then. So again, you're looking at, earlier they mentioned a 24% drop back in the 1990 recession, when you had the yield curve uninvert. So we're looking at somewhere between 24 and 89% crash crash in the market. So 24% is the best case scenario, right? That's what the data tells us, is 84% or 24% loss is the best case scenario. So for every dollar put in at the market top, you got 76 cents left over when it hits bottom. But it's more likely going to be much more severe than that. And one of the reasons why, I think, is put in this post by Ed Dowd on Twitter. So he says, fun fact, today, and today was Tuesday, marks the 95th anniversary of the 1929 stock market top 4 generations ago. And he says 95 years, 4 generations. Not sure why 95 years signals 4 generations. Everybody has a different definition of what a generation is. But the point is, the overall point and message that he's putting here is, hey, we're 4 generations removed from this. This was to remember this. Let's say you were 10 years old when the market hit its peak and then it crashed. Well, you're 105 now. And maybe there's a few 105-year-olds out there, so watching this, and leave your comments below. But there's probably not a whole lot. Most of those people are gone. Most of the people that lived through the bubble that led up to the 29 crash and lived through the aftermath of that are gone. And so they forget, right? So for those of you that were around in the 1950s and 60s and 70s, you'll probably remember many of your relatives that lived through this seemed frugal, right? Why were they frugal? Why did they live a little bit different than some generations since? Why were they reluctant to take on, run up credit card debt and run up all these different debts? Well, because they lived through this, they saw the aftermath of all this, and that stuck with them. And they said, okay, learned my lesson from this. I'm going to make sure that I'm in good shape. I'm going to make sound, wise, prudent decisions. Well, here we are 95 years later. Most of those people are gone. The memory of that is gone. And people are making the same mistakes. They're going back and saying, don't worry, the Fed's got it all under control. The government wouldn't let this happen. Not in an election year. They give all of these excuses of why it's different this time, but they don't realize, because they weren't there. And so unless you read a history book, which I advise doing, you should read books, right? Generally a good idea to read books. But if you read the history, you'll know they said the exact same things back in 1929 and 1930. Don't worry, the Fed's got this under control. The Fed's coming to bail out these banks. They're going to provide cash liquidity to the banks, to the markets. You had these bigwigs on Wall Street that came in and bought up stocks to try to prop up the market, save the day. And so day by day, it sort of looked like in late 1929 and early 1930, people weren't going, oh no, we're in the midst of the Great Depression. They thought, well, that crash back in the fall, that was bad. Things seem a little slow right now, but everything will be back on track by summertime, right? And they had no idea, but they were saying the same things that we hear people say today. So why does this matter? Why am I talking about all this? Why do I seem to, am I obsessed with cash and money and investments, and riches? No, I'm not. I'm saying all this because this is directly relevant to Bible prophecy. So again, I would remind you to check out this article. How the current global financial crisis, guys, we're in it. It's hard to see it when you're in it because of all those reasons that we just said. The media will say, oh no, it's different this time. Oh no, the Fed's coming to the rescue. Oh no, don't. People that say that are just over the top. They're fear mongers. Let me tell you why. Let me give you all these good reasons why everything's as wonderful as we say and not what you see. It's hard to see those things, but we're looking at those things because we're studying history and looking at the history. Again, I'm not a prophet, but I can read books, and I read history books. And the history books and all the data we just looked at said, when these things happen, it tends to turn out very poorly. And in this case, when the yield curve uninverts, you're looking at a 24 to 89% loss in the markets. And the maybe 3 years peak to trough, it could be as long as 3 years peak to trough. But we've hit that peak, or we may, in some cases, historically, we'll hit the peak probably this month. Maybe they cut rates in a week and a half and the market rallies and everybody goes, yay, everything's wonderful. And then that's it. And then it just goes down from there. But it's not going to go straight down. It's going to go down, then up. And everybody will say, worst is over. And then it'll go down again, even lower. And then it'll go up and they'll say, great, the worst is over. Then it'll go down more. It's going to be a process. And they're going to work through this process, and it's unavoidable. We are in it. Again, this article, if you read it, points out how the Bank of Japan is trapped. And if they cut rates, that's going to reignite the yen carry trade problem. And no matter what the Bank of Japan does, no matter what the Fed does, no matter what any of these central bankers or politicians do, it's going to turn out bad. Japan is in a lot of trouble. We're all, as nations, we're all in a lot of trouble, frankly. But Japan in particular has been manipulating their economy and with these monetary policies for 35, 40 years now. And the bill is about to come due. So we'll continue to see volatility again. The VIX measures volatility. What did that article say? We'll continue to see it. Oh, look, it's coming right back up. So we're going to continue to see volatility. If there's more debt to be taken on, we're probably right at the precipice of that. But we're going to start, my guess is we'll start to see stories about bank glitches here in the next couple of months. Oh, there's a glitch at the ATM. Bank. There's some problems processing deposits. It took a few days, or whatever it may be. There's going to be ransomware attacks. Oh, don't worry about it. Oh, there was a internet attack that took the internet down, or whatever it may be. They'll come up with their excuses. And sometime soon thereafter, there's going to be a massive government central bank panic response as they realize how bad it is, and we'll probably see a massively cut rates, and people will go, it's going to be wonderful because they're cutting rates. And then we're going to find out why they did that. Everything's breaking and these banks are all failing. Oh, we need to have a bank bail-in because that's what the law says. We can't continue to guarantee all of these deposits, so we'll just do it on this one small bank that's not political. They don't have a lot of political connections. Guys, when they do that, that will kick off the panic. I mean, again, I don't have some window into the future any more than anybody else who's read the Bible or anybody else that's paying attention to these things. But history tells us that these are the things that are coming. And again, when they do, they're going to roll out a new system as their solution. They're going to say, well, we've got the solution. Yeah, this was terrible. Sorry that all these bad things happened to people, but don't worry. We have the solution. Central bank digital currency, right? This will allow us to prevent these types of things from happening. These bank runs, these frauds that will come to light in the market. Oh, these individuals committed fraud. That was the cause of this problem, right? They'll tell us all the reasons all of this happened, except for the correct reasons, and that central bank digital currency is the solution, and then these tokenized assets, they'll be secure on the blockchain. So you don't have to worry about losing your 401k, and everybody will go, yay, give us tokenized assets. Oh, but of course, to make sure nobody steals your 401k, you need a digital ID to prove who you are. Okay, give it to me. Right? So people will demand all of these things. Central bank digital currencies, tokenized assets, digital IDs, that's going to be the new system. Once we're in that, well, the world is trapped because that system, functionally, that system is indistinguishable from the mark of the beast system. Again, that's why this is important and we're talking about it. Doesn't mean that it is the mark of the beast, that when these things are rolled out that the mark of the beast is here. Now, the mark of the beast requires the Antichrist and the tribulation. None of those things are here yet, right? They're still in the future, but it lays the foundation for it, sets up the world with that system. So when the Antichrist and the false prophet say, let's roll out this mark of the beast system, they just go, and they flip on the light switch, and there it is, because it's already been put in place, and it gets put in place by the crisis that we're going to see unfold probably over the next 2 to 3 years is my guess. Again, hopefully we won't see all of that unfold. It'd be nice to have the rapture occur today, right now. But I don't know. None of us know when the rapture is going to occur. But what we do know is that history is telling us we're about to see a market crash. We're about to see a spike in unemployment and mass layoffs, which again, God willing, I'll talk about in Monday's video. And this is going to be a very uncomfortable time period going forward until all of this is resolved. So that's what history tells us. That's what we're looking at. We're just making observations. Again, I'm not making predictions or saying God's given me some special insight. He hasn't any more than what's in his word. And we see these things coming about that match what the Bible says, and they look at history and go, wow, this is probably going to play out as it did many times before, but this time it is different, and that we have these digital systems that can be put in place that when this happened in previous generations, they didn't have. So that's what they're going to roll out as the next system. They want to roll it out, but they need a crisis. And this is their crisis. And of course, they want to keep the system in place as long as they can. They've been trying to prolong this event from happening, but they know inevitably it's going to happen. So they have the next system in place so that they can maintain their control. And that's what we're going to see. So, guys, thanks for watching this. Thanks for being a supporter. Again, if you're watching this, you're a premium subscriber. So thank you. Bless you. It's a blessing to our family that you are here. So leave your comments below. Let me know what you think. And God willing, I will see you on Monday.